Howdy, Jacob here. Today we're looking at designer brands in the specialty retail industry. Less than half a billion market cap on almost double the enterprise value. For smaller companies, the first thing I like to do is look at insider ownership, and we do see 16% held by insiders. That's a good ownership. That's a good percent ownership of the business. So likely you'll feel better as an investor knowing that management, CEO, CFO are heavily invested into the business. So they're going to likely do what's best for you as the investor because they themselves are heavily invested in the business. Definitely a statistic I like to look at, especially for smaller companies. So the growth here is down from last year and is not a whole lot of growth. They've only been around since 1991. I would have thought it was a bit longer, but they are retail of footwear and accessories for women, men, kids. They operate, what are these brands? Vince, Camuto, Keds, Hush Puppies, Topo. I'm not going to lie, I don't know. DSW, Designer Shoe Hut. Okay, I know that. I don't know any of these other brands. I'm not a brand person, so interesting. All right. Slow growth recently, though. So I think there's just a lot of competition going on, and maybe they're having trouble competing. I do think that, I mean, DSW shoes, I think people like to go in and fit their shoes. Maybe other products people don't, or maybe other people don't. I know I like to I don't like to just buy a shoe. I mean, I haven't I bought one pair of shoes in the last, like, well, I guess two because I had to buy one for the wedding, but two pairs of shoes in the last like 5 years. So I'm not the best person to go to here, but I do believe that people do like to try on their shoes before just purchasing them. I know you can bring them back with Amazon and all these other places, I'm sure, but um, I think they will have some trouble with competition. This big difference in enterprise value and market cap is definitely due to a lot of net debt here. I'm not super attracted to that. Pretty low margins, gross margin in the 30% range. Not horrendous for what I've seen for other retails, but this operating margin was pretty good, 6 to 9%, and has recently been low single digits. And they used to pay a dividend. It looks like they stopped that. Okay, so they still pay a dividend. It's a 2.7% yield, and it used to be nothing in comparison. If they were to go back to making $2, that's less than 10%. But or I guess $2 is literally 10%, but 226 less than 10%. But for right now, I mean, maybe they focus on just really trying to get back to some growth and get back to some more consistent margins. I'm not really sure what their best move ahead of them is. It looks like they didn't really have any debt until 2020. COVID kind of forced them into a lot of debt. Let's see if that's the case. Yeah, we definitely see that. So COVID hit, 2019 hit, and they issued long-term debt, and it's been going up really ever since. And that's tough to see for sure. A big increase in property and plant just because I'm guessing capital leases. Yeah. So they are retail. So capital leases are going to be a bit of them. Looks like they've dampened their capital leases. So maybe they sold off some places. I'm fine with that. I'm fine with, if you're having trouble making money, sell off your inefficient places. It's going to dampen your revenue, but it's going to increase bottom line. It's going to increase your margins even heavier. I mean, if you get rid of a money losing business, you got to think revenue goes down 5%. Your margins are going to look way better because it's based off of the revenue being much like a little bit lower. And so I don't mind that. I know a company like Big Lots definitely needs to work on something like that, but designer brands, maybe they do as well. And maybe, they're already making a little bit of money on the earnings side, and free cash flow, they're making money. So they're still making money. I just want them to this buyback of shares. Maybe it's a great price, but I do get a little bit scared when it comes to debt. And although their free cash flow has historically been well above 100 million, most recent year we're only looking at 64 million. And so if they can get back to that 100 million pretty easily, then I'm not really scared about the debt because it's only 420 million in long-term debt. So that's 4 years. Not terribly concerning for a company that makes decent production of free cash flow. But if this starts to go off a cliff and they can't get cash from operations up, I mean, I would be definitely a little scared. And so maybe this is a comeback play. Maybe, we're saying that they get back to these margins, but I do think competition is going to be tough, and I'm going to have to put that into my assumptions. So for revenue growth, I'm going to be conservative. I'm going to say there's no revenue growth. I want a 10 P price to free cash flow. I mean, the enterprise value is quite a bit higher in market cap, but it's not terribly concerning. So maybe I'll do 9 P price to free cash flow. For margins, I mean, they're going to have tough time getting margins, but let's say that they push through, get 3% margin on the free cash flow side. Buying back shares, I don't want them to buy back as many shares because I want them to reduce that debt figure. So if they can get back to $100 million, I want $50 million a year to go back to debt reduction or to go to debt reduction, which means they have about $50 million of capital allocation for acquisitions, share repurchases, and I think they can get 1% with 25% acquisition, 25% on share repurchases, about 25 million, which is just going to offset stock-based compensation. So you're not really looking at any share repurchases here. The dividend, 12 million. I mean, that's pretty small in relation to that 100 million I was talking about. So I'm fine keeping that. That's fine. So this is assuming about 40 to 50% to debt reduction, 10% to the dividend, and then about 20 to 30% to acquisition, 20 to 30% for just share repurchases. That's getting us to the company needing to fall 28% before you get the return we look for here. I mean, these are interesting assumptions for sure. I think if you understand this business and you know it a lot better, and you know very confidently that they're able to get back to those 4, 5, 6% margins, this could easily be a fantastic time to buy. It looks like it's been beaten down like crazy. And so if you are confident and you've read all, 10K, 10Q, you've read about their competition, you feel confident that they'll stick with it, this is easily a good price. But for me right now, based on my assumptions, I'm still going to be a little bit hesitant to jump on board immediately and before doing more research. But I hope you enjoyed the video and have a great rest of your day.